I think it was really hard to keep that hysteria level in August high because I think people thought a recession was around the corner, and I think the S&P had every chance to break down huge in the month, and instead we're breaking out of the range and kind of approaching all-time highs. So I think it's a very important signal.
But it doesn't mean that the volatility isn't over, does it? Has anything fundamentally changed from what spooked the market in August to now?
If I had to say what's changed, number one, the volatility has come down, right? If you look at the VIX level or the VIX term structure, they've actually really gone to pre-August levels. So it's telling us the market's feeling a lot better. But I think the most important signal to us or message to us is the S&P's been decoupling from the rest of the world. The equity market, the S&P's held up really well. It's kind of telling us that the business cycle isn't as weak as the market believes. And as Stephanie mentioned, it's probably more indicative of a slow growth period rather than a recession around the corner.
Stephanie, does it also show you, though, that the market still ultimately reacts to macro headlines above all else?
Well, without earnings season, right? Absolutely. But I think conference season should actually help. But I do think not only is the U.S. kind of leading the charge in terms of growth, I think people were really extra worried about China and the slowdown in China, the deceleration. And actually, the data points in China have actually gotten better. The Caixin PMI services yesterday actually had a 3-month high. They announced more stimulus overnight, which didn't get a lot of press, believe it or not. Auto sales are stabilizing. So I think if China can stabilize, that's actually a good thing, right? Obviously, because that has implications for global growth overall and perhaps not this recessionary fear.
But what's also stabilized and has been helpful for equities, Tom, is bond yields. I mean, we're not that far from the lows, but we're back above 150 on the 10-year. So how important is that correlation going to be? And do you think that if we head south again on yields, that's going to spook the equity market?
I think it just depends on the regime. There's times when people think lower yields means higher stock prices, and now we're probably in an environment where people want higher yields. I don't think there's a direct relationship necessarily, but I think fundamentally, interest rates are lower, so mortgage costs are going to go down. Consumer borrowing costs are going to go down. So I think it's actually stimulus. I think there's some positives that have come out of lower rates.
One of the things in your notes, Tom, about why you're bullish long-term U.S. equities is the cash return yield that's available, buybacks plus dividends. Do you think investors would give that a higher weighting in their considerations if it was all dividend yield? Does dividend yield sort of shout, this is cheap, louder than buybacks does?
It's a great question. Dividend yields have been attractive in Europe for a while, and I think people have argued that European stocks are cheaper when they look purely at dividend yield. But then when you factor in cash return, which is buyback, because it's true free cash generation, U.S. companies are not only returning cash, they're building up huge cash hoards. You're not seeing that in Europe. So I think U.S., and we write about this in our note, 36% of U.S. companies are in what you call high-value sectors. They contribute significant profits and value capture, and that's why they're building cash. It's only like 10% of companies in Europe and like a similar percentage in other regions. So the U.S. actually has really profitable companies, and so cash return to us matters a lot more than dividend yield. Who's
going to lead us to new highs in your bullish forecast? Because it's not FANG. Netflix down for the month.
I'm going to sound a little contrarian, but I think the cyclical trade is going to be the big trade into the end of the year because the ISM's turned down and people got really defensive, but that downturn was telegraphed by the long-term yield curve 16 months ago. And that same curve is telling us cyclical growth is picking up. Stephanie mentioned a few other data points that seem really cyclically bullish. Platinum's been rising. I think inflationary pressures could be building in the U.S., and that's bullish for cyclical stocks.
Copper hasn't, though, and oil in general hasn't. But Stephanie, do you agree with that? Do you want to add beta to cyclical sectors?
Well, they're certainly under-owned, and the value is definitely there, meaning technology, financials, energy, industrials. I'm overweight all of those sectors, and it's been very painful, to be honest with you. It's been the defensive trade pretty much all year. So I think if you can see China stabilize, and you get more stimulus there, and you see us kind of stabilize, I do. I think you can see a rotation. I think you can see a rotation away from this very crowded these other sectors that are very crowded.
I guess the question is on industrials and the manufacturing exposure. Isn't that doing the worse than the rest of the economy, Tom? So is it all cyclicals, or is it cyclicals X supply chain manufacturing, trade exposed?
Well, remember, consumer discretionary are cyclicals. Tech is cyclical. You really want to be overweight those, but I think the PMIs are a confidence index. I mean, if the markets are choppy and someone says all these regional PMIs are below 50, it's because the purchasing manager is looking at the stock market as well. I mean, it's very influenced by contemporaneous factors. So I would say, without question, if someone thinks the PMIs below 50 is a big issue, I'd say it's definitely signal, but I would have expected it to be a lot worse given the plague of negative rates and the inversion of the curve and the hysteria that surrounded it, and it was 49.
And just remember, these stocks are down so much. All of the industrials are down so much. They've lagged for a while. So not a lot has to go right for them to at least see a bounce.